Hello and welcome to another stock analysis on Stock Market Palantir. Don't forget to put your comments and subscribe. Okay, now let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about YYAI. Now, this stock is currently known as RWAI Inc., but a lot of our listeners will probably remember its recent past as Connexa Sports Technologies Inc., and even before that, Slinger Bag Inc. We are really analyzing a company that has executed one of the most radical corporate pivots in recent memory. They've gone from tangible consumer hardware, tennis equipment of all things, to becoming a self-proclaimed pioneer in real-world asset, or RW, tokenization.
Yeah, and that makes it a quintessential special situation asset. And the market action, just here in early December 2025 has been, well, nothing short of explosive.
Explosive is the word. But we need to ground that for everyone. The market context is just crucial here.
It is. We are talking about extreme volatility. YYAI saw this massive surge on December 8th, where the stock rallied approximately 23% in a single day. It traded as high as $1.21.
And that alone isn't shocking for a microcap, but the volume.
Exactly. The volume. It traded over 16 million shares. Now, given the recent capital restructuring, that is a volume equal to or maybe even exceeding the entire readily tradable float.
Right. And this whole dynamic, it's being driven by a really sharp divide in opinion. On one side, you have the momentum camp. They see this unique high-growth opportunity in Web3 infrastructure. They think the RWA pivot is legitimate, transformational.
And on the other side?
On the other side is the structural bear camp. They see all this price action as purely mechanical, a function of low float and trading arbitrage.
Okay, so that brings us to our central question for today. Does YAI's strategic pivot to the airway exchange and its crypto capitalization represent a fundamentally legitimate high-growth investment opportunity? Or is the stock primarily just trading as a highly leveraged float rotation vehicle that's driven solely by these market microstructure dynamics?
And I'll be arguing the latter. I contend that the overwhelming structural history of this company, a history just defined by continuous capital engineering and dilution, makes any investment proposition fundamentally speculative. It's driven by survival, not growth. The risk is just immense.
And I'm going to take the position that, well, yes, the history is undeniably checkered, the significant cash asset injection, and the blue sky potential of the Web3 thesis provide a really compelling strategic arbitrage. For the aggressive investor, the potential upside justifies the speculation.
Okay, so my core thesis is that this corporate metamorphosis is, well, it's a timely and potentially highly rewarding strategic arbitrage. It's rooted in capitalizing on the Web3 infrastructure boom before the traditional markets really catch on. And the most compelling, tangible evidence for this sits right on the balance sheet.
You talking about the Solana?
Exactly. The company received approximately $30 million in Solana, SOL, tokens. This isn't theoretical. This is liquid capital. And that injection fundamentally alters the company's financial footing. It acts as a clear war chest for development, and crucially, it provides an immediate, verifiable floor for the net asset value. Overnight, this transforms YYAI into a legitimate high beta proxy for the cryptocurrency market itself. If crypto rallies, this stock benefits.
And that reliance on a crypto proxy is precisely where the risk lies. But let's address the structural damage first. I agree, 30 million in liquid assets looks appealing on paper, but you have to look past the balance sheet and focus on the damage that's been done over the last few years, because that defines this company's DNA. The key evidence against its long-term viability is the staggering shareholder dilution. Between 2022 and 2025, the company executed reverse splits, culminating in a cumulative ratio of an astounding 1 for 400,000.
Right.
Think about that number. 400,000 shares collapsing into just one. That trajectory, that is the story of a company in a perpetual survival cycle, not one that's achieving genuine growth.
But those splits, especially the recent 1 for 50 in October, they were necessary. They were defensive actions just to maintain NASDAQ compliance and keep the listing. That's what gave them the platform to even execute this transformation.
Necessary, perhaps, but they create a destructive structural trap. The reliance on these repeated reverse splits, it only addresses compliance. It completely fails to fix the underlying valuation disconnect. The market cap hasn't magically grown. The share count has just been aggressively, reduced. And this leads to the optical illusion problem, which is vital for retail investors to get. That widely cited historical high, that split-adjusted price of $264, it anchors traders into thinking the stock is cheap.
Right.
They ignore the immense, maybe impossible market cap required to ever get back to that level. And about that $30 million war chest, its stability relies entirely on the volatile beta of SOL. If Solana crashes 50%, that asset base contracts instantly. That introduces massive risk directly onto the balance sheet.
I see why you emphasize the legacy. And yes, the dilution is a critical factor. But let me get back to the value proposition today. It's greater than just the SOL holdings. We're talking about the credibility of the Web3 transformation itself. The core business plan, this ARWEI exchange for tokenized U.S. equities and commodities, it targets a massive, currently unaddressed market. It's promising 24/7 liquidity and T+0 settlement.
Okay, hold on. We should probably clarify what T+0 settlement means for anyone listening.
Good point. T+0 means the transactions clear and settle instantly, same day, unlike the current T+2 or T+1 standard in finance. That instant finality is a huge differentiator. They're positioning themselves as a potential Coinbase for stocks, offering something that fundamentally improves market efficiency. And, consider the valuation. When you compare the recent low market cap, around 20 million, to that 30 million in liquid crypto, the stock appears to be trading with a negative enterprise value. You're basically paying less than the cash they have on hand.
That's a compelling arbitrage argument, but it rests on two massive assumptions. First, that the business has zero negative value. And second, they can actually access that SOL efficiently. But let's look at the partnership claims. The joint venture with Jucoin announced with a $500 million valuation. That implies a theoretical valuation gap that is fueling a lot of this optimism. Since Eriqua holds a 51% stake, the implied asset value is $255 million, against a market cap often below $50 million.
And that huge disconnect is exactly why the speculation is justified. It's not just a headline either. They're building the infrastructure, contracting Inca Digital for security services. That shows a concrete commitment to market surveillance and regulatory concerns. It shows they're serious.
Okay, but I would frame that very differently. Professionals have to scrutinize that $500 million figure. Headline numbers in crypto JVs, they often lack substance. We have a crucial lack of audited clarity here. I mean, what is the contribution from both sides? Is it cash? Is it proprietary tech with a verifiable valuation? Or is it just illiquid tokens? That lack of transparency, it significantly de-risks the headline number. It's paper value until it generates revenue.
But the ambition of the market they're addressing is still real.
The ambition is real, but the immediate reality is regulatory friction. The company faces the immense hurdle of the U.S. SEC to trade tokenized U.S. equities here. So while they've announced successful test runs, the pathway for a small, recently restructured company to gain U.S. regulatory approval, it's incredibly long and complex. This suggests their initial operations will likely be limited to non-U.S. jurisdictions, like the META region. And that geographic pivot introduces all sorts of risk that the retail crowd focusing on the Coinbase for stocks narrative just completely misses.
Which brings us squarely back to the market mechanics. Because if that regulatory timeline stalls, which is likely, the stock's performance has to rely on microstructure, and that's exactly where the leverage is. Was the recent price action driven by belief in the RWA thesis or purely by mechanical trading forces? I say it was the latter, acting as a powerful accelerant for the former. The surge on December 8th confirms that the technical setup was optimized for a micro squeeze.
Optimized, yes. But let's define the terms. We're talking about a low tradable float, estimated under 8 million shares after that 1-for-50 reverse split. That's small float, combined with near zero availability of shares to borrow. It dropped to just 400 shares on December 4th. It created a structural tinderbox. So the extreme volume on the 8th, it confirms that the buying pressure forced shorts to cover, causing this self-reinforcing rally. It wasn't just organic belief. It was a structural necessity for short sellers who were suddenly trapped.
But I don't buy that it was purely an organic short squeeze. You have to interpret the dark pool data carefully, because it suggests a much more managed volatility. FINRA reporting consistently showed off-exchange short volume ratios up to 64% during key sessions, like on December 5th. This extremely high ratio is highly indicative of market maker intermediation.
And what exactly does that intermediation mean for the average investor?
It means that the market makers are aggressively selling short to absorb all that intense retail buy demand. They're providing liquidity, they're fulfilling retail orders by creating shares on the spot, betting they can cover later at a lower price. Now, while this can lead to a squeeze if they can't cover, it fundamentally means the price is being managed by sophisticated algorithms, not solely by organic, long-term speculative buying.
But that strategy only works until the cost of holding that short position becomes prohibitive, which is why we have to look at the cost to borrow. It was reported at 34.61%. That is punishing.
It is.
That high cost incentivizes shorts to be tactical and quick. They can't afford to hold those positions for long, which places a high-pressure buying floor under the stock as they're forced to cover to avoid those fees.
Okay, the cost to borrow is a ticking clock for shorts. Absolutely. But let's also look at the structural plumbing of the system. Go back to October. After that 1-for-50 reverse split, we saw a massive October fails to deliver, or FTD spike, up to 98 million shares. For listeners, an FTD is simply a failure to settle a trade on time. That massive spike, right after the split, confirms a crucial point. The initial volatility stemmed primarily from a structural plumbing reset in the settlement system.
You're talking about the CUSIP change.
Precisely. When a company does a reverse split, the identification number, the CUSIP, changes. This triggers a massive share reconciliation process across all brokers. The system just struggles to adjust, resulting in widespread FTDs. So a lot of that initial mechanical pressure, the lack of shares to borrow, the high short ratio, it was a consequence of the system struggling to process the engineering rather than a philosophical short position taken against the RWA thesis.
That is a valuable distinction. It reinforces that this stock is a battleground between technological possibility and capital history. The advocate's perspective is that the immediate leverage from the balance sheet and the low float mechanics currently outweigh the historical toxicity, at least for the aggressive tactical trader.
And the structural perspective is that this stock remains a financial Frankenstein. It's a company stitched together from old liabilities and new crypto hype, still operating in a dangerous dilution cycle. It is right now sustained by speculative flows and the optical illusion of those historical price highs.
So my view remains, YYAI is a leveraged, momentum-driven play that acts as a powerful crypto proxy. While the capital history is toxic, that 30 million in Solana provides a compelling foundational floor, and the blue sky potential of RWA tokenization gives the catalyst for aggressive speculation, especially with the low float mechanics. The risk is high, sure, but the potential reward makes it a unique opportunity.
And mine remains that you have to respect the historical gravity of the capital structure above all else. The structural flaws are too significant to ignore. It is a highly tactical asset where the structural threat of 1 for 400,000 dilution poses a significant threat to long-term capital, regardless of the technological promise. The true long-term value remains subject to two distinct, equally compelling forces: the transformative potential of the ARWA exchange and the restrictive, aggressive mechanics of its heavily engineered capital structure.
And the value of this material is illuminated by considering both forces at the same time.
We leave the listeners to weigh the technical promise against the structural constraints. Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights. And see you in the next video.